Unit 3. In this unit, our aim is to introduce the reader the important transaction associated with foreign exchange. The unit is divided into two chapters. In the first chapter, we discuss the various facets of foreign exchange transaction. The second chapter discusses the transaction carried out by important participants in the foreign exchange market viz. The merchant transaction and interbank transaction. Chapter 1 Foreign Exchange Transactions Introduction. In the globalized economic environment of today, economic activity is globally unified to an unprecedented degree. Thus, changes in one nation economic are rapidly transmit to that nation's trading partners. This fluctuation in economic activity are reflected almost immediately in fluctuation in currency values. The movements of capital across the countries of the world taking the form of foreign direct investment by multinational corporations involved to a greater extent the transaction in the alien country's currencies. In the domestic economy, financial management is considered with the cost of financing sources and the payoffs from investment. However, in the domestic economy, movements of exchange rate are substantially ignored while one move outside into international arena. There is no way that we can analyze international financing and investment opportunities without understanding the impact of foreign exchange rate. Foreign investment aim at overcoming foreign market regulation, reducing production costs, taking advantage of new market opportunities, each are by no means new or recent origin. However, new trends and dimensions of such investment are discernible. The globalization of business has been create new trading environment emerging from economic integration and trade agreements among the countries of the world. Economic liberalization in many countries initiate a proactive role by companies with large cash surpluses to venture into foreign businesses. If money is the language of business, foreign exchange is the language of the international business. In this respect, our aim in this unit it is to discuss the various facets for foreign exchange transaction. Foreign exchange meaning. When trade takes place between the residents of two countries, the two countries being a sovereign state have their own set of regulation and currency. Due to this problem arises in the conduct of international trade and settlement of the transaction while the exporter would like to get the payment in the currency of his own country. The importer can pay only in the currency of the importer's country. This creates a need for the conversion of the currency of importer into that of the exporter's country. Foreign exchange is the mechanism by which the currency of one country gets converted into the currency of another country. The conversion is done by banks who deal in foreign exchange outside into international arena. There is no way that we can analyze international financing and investment opportunities without an understanding of the impact of foreign exchange rate. Foreign investment aim at overcoming foreign market regulation, reducing production costs, taking advantage of new market opportunity each are by no means new or recent origin. However, certain new trend and dimension of such investment are discernible. The globalization of business has created new trading environment emerging from economic integration and trade agreements among the countries of the world. Economic liberalization. Many countries initiate a proactive role by companies with large cash surpluses to venture into foreign business. Money is the language of business. Foreign exchange is the language of international business. In this respect, our aim this unit is to discuss the various facet foreign exchange transaction. Foreign exchange market. Unlike commodity market where we see specific location selling various commodities, there is no specific location for foreign exchange market. An American company importing goods from Germany with their price denominated in Deutsche Mark may buy marks in order to pay for the goods. An American company exporting goods to Germany, again with a price denominated in marks, receive Deutsche Mark, which it may sell in exchange for dollars. The currency aspect of this transaction involves use of the foreign exchange market exists even in a remote village where the villager approaches the bank of this village to get converted the remittance received from his relative working abroad. To that extent, foreign exchange market exists throughout the world. However, the volume of transactions in this market are so few that they are not well recognized as foreign exchange market. Based on the volume of transaction carried out, we can distinguish foreign exchange market like London, New York, Tokyo, etc. However, in most of these centers, the foreign exchange market has no central physical marketplace. Business is conducted by telephone or telex. The main dealers of commercial bank and central bank factors that affect the equilibrium exchange rate. Some of the factors that influence currency supply and demand are balance of payment, inflation rates, interest rates, economic growth, and political economic risk. Balance of payment, foreign exchange rate is the price of one currency in the term of another. The balance of payment summarizes that the flow economic transaction between resident and the given country and the resident of the other countries during certain period of time. Balance of payment represents the demand and supply of foreign exchange, which ultimately determine the value of currency. When the balance of payments of a country is continuously deficit, it implies that the demand for the currency of that country is lesser than its supply. Therefore, its value in the market declines. If the balance of payment is surplus continuously, it shows that the demand for the currency in the exchange market is higher than its supply. Therefore, the currency again value relative inflation rates. Suppose that the supply of dollar increases relative to its demand. This excess growth in the money supply will cause inflation in the U.S., which means the U.S. prices will begin to rise relative to prices of German goods and services. German consumers are likely to buy fewer U.S. products and begin switching to German substitutes, leading to this increase in the amount of euros supply at every exchange rate. Similarly, higher prices in the United States will lead American consumers to substitute German imports for U.S. products, resulting in an increase in the demand for euros. In effect, both Germans and Americans are searching for the best deals worldwide and will switch their forecasts accordingly. Hence, a higher rate of inflation in the United States than in Germany will stimulously increase German export to the United States and reduce U.S. export to Germany. In other words, a higher rate inflation in the United States than in Germany will lead to the depreciation of the dollar relative to the euro, or to an appreciation of the euro relative to the dollar. In general, a nation running a relatively high rate of inflation will find its currency declining in value relative to the currencies of countries with lower inflation rates. Relative interest rate. interest rate differentials will also affect the equilibrium exchange rate. A rise in U.S. interest rates relative to Germany rates, all else being equal, will cause investors in both nations to switch from euro to dollar. Denominate securities to take advantage of the higher dollar rates. The net result will be depreciation of the euro in the absence of government intervention. Foreign exchange transaction. Forecast and sell transaction. The transaction in foreign exchange market is synonymous with commodity market, while a trader has to forecast goods from his suppliers, which he sells to his customer in a similar way that bank which is authorized to deal in foreign exchange forecasts as well as sells its commodity, the foreign currency. Therefore, the foreign currency can be considered as a commodity in foreign exchange dealings. Whenever we talk about foreign exchange, 2 points need to be kept in mind. The transaction is always from the bank's point of view and the items referred to is the foreign currency. Therefore, when we say forecast, we imply that the bank has forecast and it has forecasts. Foreign currency is similar. When we say a sale, we imply that the bank has sold and it has sold. Foreign currency is a forecast transaction. The bank acquires foreign currency and part with home currency. In a sale transaction, the bank parts with foreign currency, home currency. In a foreign exchange transaction, forecast, sale, bank acquires parts, foreign with home with currency, foreign currency. Foreign exchange quotation. Methods of quotation. The exchange rate may be quoted in two ways. 1. Direct quotation or home currency quotation, and 2. Indirect quotation of foreign currency quotation. For instance, a fruit vendor may express the price of apple in either of the following two ways. Method 1. One apple costs Rs 10. Method 2. For Rs 100, 10 apples. In both the case, the value of apple or the rupee is the same, thought expressed differently. In method 1, the price per apple is quoted in rupees. In method 2, the unit of rupees kept constant at 100 and the quantity of fruits is varied to reflect their prices. The same is also true for foreign currency. In foreign exchange also, the rate of exchange can be quoted in two ways. Method 1, USD 1 Rs 43.20 or USD 1 43.30. Method 2, Rs 100 equals USD 2.3409 or Rs 100 equals 2.3200. The quotation under method 1, in which exchange rate is expressed as the price per unit of $1 in terms of the home currency, is known as home currency quotation or direct quotation. It may be noted that under direct quotation, the number of units of foreign currency is kept constant and any change in the US dollar quote at under different values of rupees. Under method 2, the unit of home currency is kept constant and the exchange rate is expressed as so many units of foreign currency for a fixed unit of home currency, is known as foreign currency quotation or indirect quotation. Under indirect quotation, any change in exchange rate will be affected by changing the number of units of foreign currency. For instance, the rate Rs 100 equals USD 3,400 may become in due course USD 2.2450 or USD 2.3785 and so on. The indirect quotation is used in London foreign exchange market. In New York and other foreign exchange market, mostly the direct method is in Boji. In India earlier, we had used indirect method. However, from August to 1993, India has switched over the direct method of quotation. The change has been introduced in order to simplify the established transparency in exchange rate in India. Transaction under direct and indirect quotation. Under direct quotation, the bank buy the foreign currency at lower price and selling it to a customer at a higher price. For instance, a bank may buy US dollar at Rs 46 and sell at 46.20 and thus book a profit. Therefore, under direct quotation, the maxim is buy low, sell high. In the case of indirect quotation, while buying, the bank would acquire more units of foreign currency for a fixed units of home currency, and while selling part with lesser unit of foreign currency for more units of home currency. Therefore, the maxim under indirect quotation is buy high and sell low. Two-way quotation. The first area of mistake in foreign exchange quotation arises from the fact that they are two-way or quoting rates, the direct quote and the indirect quote, that we already discussed. The former gives the quotation in terms of number of units of home currency necessary to buy 1 unit of foreign currency. The latter gives the quotation in terms of the number of units of foreign currency bought with 1 unit of home currency. Foreign exchange dealer quote two prices, one for selling and other for buying. Therefore, in the foreign exchange market, quotation are always both buying and selling. For instance, the bank may quote its rate for dollar as followed: 1 US dollar Rs 46.57, 46.75, or Rs 100 equals USD 2.2432 or 2.2768. While in case 1 of US dollar Rs 46.57 or 46.75. The first Rs 46.57 is the buying rate. The second 46.75 is the selling rate. On the other hand, the case of Rs 100 USD 2.2432 or 2.2768. The bank agrees to sell at the rate of USD 2.2432 for Rs 100. The bank is willing to buy at USD 2.2768 for Rs 100. The buying rate is known as the bid rate and the selling rate is known as offer rate. Continental European dealer normally quote via the direct method. In London, dealers use the indirect method. In the US, both quotation methods are used. When a bank is dealing with a customer within the US, indirect quotation is given, but when dealing with other banks in Europe, except the UK, the indirect quotation is used. Foreign exchange dealer quote two prices: the rate at which they are prepared to sell a currency and that which they are prepared to buy. The difference between the bid rate and the other is the dealer spread, which of one the potential sources of profit for dealers. Whether using the direct quotation method or the indirect quote, the smaller rate is always termed the bid rate and the higher is called the offer or ask rate. The size of the bid-offer spread varies according to the depth of the market and its stability at any particular time. Depth of a market refers to the volume of transaction in a particular currency. Deep markets have many deals, shallow markets have few. High percentage spread are associated with higher uncertainty and low volume as a transaction in a currency. Lower spread are associated with stable high volume markets. Deep markets usually have narrower spread than shallow one. Spot and forward transaction In foreign exchange transaction, the transactions are not complete on the same date. The actual exchange of currency may be take place at different time period. For instance, let us suppose that there are two banks in a foreign exchange transaction. Bank of India agrees to buy from Bank of Baroda British Punch 1 lakh. The actual exchange may take place one on the same day or two days later or three someday late, say after a month. In case one, where the agreement to buy and sell is agreed upon and execute on the same date, the transaction is known as cash transaction. It is also known as value today. In case 2, if the settlement takes place within 2 days, the rate exchanged effectively for the transaction is known as spot rate. In case 3, while the delivery and payment takes place after a month, then the transaction in which the exchange of currencies take place at a specified future date is known as forward transaction. The forward transaction is an agreement between two parties requiring the delivery of some specified future date of a specified amount of foreign currency by one of the parties against payment in domestic currency by the other party at price agreed upon in the contract. The rate of exchange applicable to the forward contract is called the forward exchange rate, and the market for forward transaction is known as forward market. Cross rate. A cross rate may be defined as an exchange rate which is calculated from two or more other rates. Thus, the rate for Deutschmark to the Swedish krona will be derived as the cross rate from US dollar to the Deutschmark and the US dollar to the krona. The practice in world foreign exchange market is that currencies are quoted against the US dollar. If one bank asks another bank for its Deutschmark rate, that the rate will be quoted against the US dollar unless otherwise specified. Most dealings are done against the US dollar, hence it followed that the market rate for a currency at any moment is most accurately reflected in its exchange rate against US dollar. A bank that was asked to quote sterling against the Swiss franc would normally do so by calculating this rate from the sterling dollar rate and the dollar Swiss franc rate. Thus, the cross rates would be used to determine the quotation. This could be explained with the help of an illustration. Let us suppose that we required a quote for Swiss franc against the Deutschmark. The quotation which would receive was derived through the quote of both currencies against US dollar. If these rates against the US dollar were 1 S equals SFR 1.1326 or 1.1336 and S1 DM 1.3750 or 1.3755. It would be possible to derive the cross rate for the Swiss franc against Deutschmark. Our aim is to derive the selling and buying rates for Swiss franc in terms of Deutschmarks. If we are selling Swiss franc, we will be buying Deutschmark. So we begin with the rate for selling Swiss francs and buying dollars. We then move to selling dollar and buying Deutschmark. The amalgamation of these two rates gives us the rate of selling Swiss franc and buying Deutschmark. The rate selling Swiss franc to the dollar and buying dollar is SPR 1.1336. The rate for selling Swiss dollar and buying Deutschmark is DM 1.3750. So selling SO 0.8822 gives DM 1.2120. Thus, the rate for selling Swiss franc and buying Deutschmark is SFR 1 equals DM 1.2130 or DM1 equals SFR 0.8244. Example, let us assume that the interbank rate for US dollar to Indian rupee is S1 equal Rs.34.2400 or 34.2600, and the rates in the interbank for US dollar and French franc are S1 equals French FR 4.9660 to 4.9710. From the above information, we can arrive at the rupee franc rates as followed. In the first instance, the customer buy US dollar market in India at S1 selling rate of Rs 34.2600. The US dollar thus acquired is disposed of in the London market for French franc at the market buying rate S1 was French franc 4.9660. Therefore, the rupee franc rate is French franc 1 equals 34.2600 or 4.9660 equals 6.8989. Rounded up to Rs 6.8990. Cross rate and chain rule. The fixing of rate of exchange between foreign currency and Indian rupee through the medium of some other currency is done by what it is known as chain rule. The rates thus obtained is the cross rate between these currencies. For example, let us assume that in the interbank market dollar is quoted at Rs 42.50 and at Singapore market dollar is quoted at CHF 1.8,000. From this information, the rate of exchange of Swiss franc in terms of rupees may be calculated as followed. Rs equals CHF 1 if CHF 1.8,000 equals USD 1 2 and USD 1 equals Rs 42.50. 3. It should be noted that the currency which appear as the second item right-hand side in the first equation appears as first item left-hand side in the next equation. Thus, franc appear on the right-hand side in the right equation, left-hand side in the second equation. US dollar which appear on the right-hand side in the second equation appears on the left-hand side. In the third equation, the rate of exchange between Indian rupee and Swiss franc can be calculated by dividing the product of the right-hand side by the product of the left-hand side. 42.50 times 1 times 1 equals Rs 26.5620. 1.8,000. Ready rates based on cross rates in the international foreign exchange market. The exchange rate for other currencies are quoted in the base of the rates for the currency in terms of US dollar. They have to be converted into rupee before quoting to the customer. For exchange quotation international markets, with a few exceptions, in the international market, all rates are quoted in against US dollar. For instance, at Singapore Swiss franc may be quoted at 1.5425 and 5,440, and Japanese yen at 104.67 to 70. This should be understood as USD 1 equals CHF 1.5425 to 1.5440. USD 1 equals GPY 104.67 to 104.70. While interpreting an international market quotation, we may do that either from the variable currency or the standard currency viz. the dollar in the above quotation, in which Swiss franc are received in exchange for a dollar as A. Forecasting of Swiss franc against dollar, or B. Sale of dollar against Swiss franc. For the sake of uniformity, we will assume that the standard currency as the currency being bought or sold. The quotation for Swiss franc is CHF 1.5425 and CHF 1.5440 per dollar. While buying dollar, the quoting bank would part with fewer francs per dollar, and while selling dollar would require as many francs as possible. Thus, CHF 1.5425 is the dollar buying rate and CHF 1.5440 is the dollar selling rate. It may be observed that when viewed from dollar to exchange quotation, partakes the character of the indirect quotation in the maxim buy low, sell high is applicable. We will denote such rate as dollar foreign currency rates, implying that dollar is being bought or sold against foreign currency. Few currencies such as pound, sterling, and euro are quoted in variable units of USD. They are quoted as so many US dollar per unit of foreign currency concerned. The standard current here is the foreign currency and will indicate such quotation as foreign currency dollar rate. The quotation for buying and selling of foreign currency against dollar. Forward margin swap points. Dollar foreign currency quotation at Singapore market. Dollar may be quoted against Swiss franc and Japanese yen as follows. Swiss franc, Japanese yen, spot 1.5425 to 40, 104.67 to 70. 1 month forward, 50 to 60, 17 to 16, 2 months forward, 70 to 80, 30 to 29. The forward margin, also called swap margin or swap point, is quoted in terms of point, and point is the last decimal place in the exchange quotation. It could be a point is 0.001 or in a 2 decimal quotation like 0.01. If the forward margin is ascending order, then forward margin is at premium. Premium is added to the spot rate to arrive at the forward rates, both in respect of purchase and sale transaction. The forward margin is given in descending order, then forward margin is at discount and deducted from the spot rate to arrive at the forward buying and selling rate. Using the information already available, the forward rates for dollar against Swiss franc are arrived at as follow. Dollar by buying selling 1 month forward CHF 1.5475 1.5500. 2 months forward CHF 1.5495 1.5520. As again Japanese yen, the forward dollar is at discount, i.e. the forward margin is descending order. Therefore, discount is deducted from the spot rate to arrive at the forward rate both for buying and selling. The forward rates for dollar against Japanese yen based on the data already given are as follow. Dollar by buying selling 1 month forward GPY 104.50 104.54. 2 months forward GPY 104.37 104.41. Foreign currency dollar quotation. Let us assume the following exchange rate are prevailing. Pound sterling euro spot 1.4326 to 48, 1.325 to 35. 1 month forward 50 to 53, 65 to 62. 2 months forward 90 to 93, 84 to 82. Against dollar, the forward pound sterling is at premium, should be added to the spot rate to arrive at the forward rate. Thus, the forward rates for pound sterling as followed. Pound sterling, buying, selling. 1 month forward USD 1.4371, 1.4401. 2 months forward USD 1.4416, 1.4441. forward euro is at discount. Since the forward margin is quote in the descending order, discount should be deducted from the spot rate to arrive at the forward rate. Based on the data given, forward rates for euro can be arrived at as follow: euro buying selling 1 month forward USD 1.260, 1.273, 2 months forward USD 1.241, 1.253. Determination of forward exchange rate. Forward rate may be the same as the spot rate for the currency, then it is expressed as at par with the spot rate. Forward exchange operation carry the same credit risk as spot transaction but for longer periods of time. However, there are significant exchange risks involved. It is necessary to consider how forward rates are quoted by foreign exchange dealer. A forward foreign exchange contract is an agreement between two parties to exchange one currency for another at some future date. The rate at which the exchange is to be made, the delivery date, and the amount involved are fixed at the time of agreement. The forward rate for a currency may be costlier, cheaper than its spot rate. The difference between the forward rate and the spot rate is known as the forward margin or swap point. The forward margin may be either at premium or at discount. If the forward margin is at premium, the foreign currency will be costlier under forward rate than under the spot rate. If the forward margin is at discount, the foreign currency will be cheaper for forward delivery than the spot delivery. Consider an example in which the US dollar is the base currency and the Deutschmark is the quote currency. Assume that the spot rate is S1 equals DM 1.3753. The rate quoted by a bank today for delivery in the 3 months time, today's 3 months forward rate is S1 equals DM 1.3748. In this example, the dollar buys fewer Deutschmark in the 3 months time that it doesn't today. So the Deutschmark is more expensive in the forward market. Thus the dollar stands at a discount relative to the Deutschmark. Conversely, the Deutschmark stands at a premium relative to the dollar. The price of the dollar discount or Deutschmark premium is the difference between 1.3753 and 1.3748, that is 0.05 pfennigs. The convention in the foreign exchange market is frequently to quote in terms of points or hundredths of a unit. Hence, 0.05 pfennigs is frequently quoted as 5 points. In order to arrive at the forward pieces, the Deutschmark premium or dollar discount must be subtracted from the spot rate. Were there a Deutschmark discount or dollar premium, this would be added to the spot rate. But care has to be taken in our example use a New York indirect quote. Had we used a New York direct quote, the reverse would apply. In other words, the Deutschmark premium of dollar discount would have to be added to the spot quotation. An easier way to deal this problem is always to remember, and this has never in practice been found to be otherwise, that the bid-offer spread and the forward quote is always wider than the spread on the spot figure. If this is remembered, it is an easy to process to compare the two spread, and if the forward spread is narrower than the spot spread, the sum have been done incorrectly and recomputation is necessary. Calculation of forward margin. Example, the forward margin can be calculated for a specific period given the spot rate and interest differential. Let the spot rate and interest rate differential are as follows. Spot rate S1 equal Deutschmark 1.5 thousand and the interest rate differential is equal to 8% US 3.5% and DEM 11.5%. Let us also assume that the number of days in a year to be 360 days and the forward margin is for a period of 180 days or 6 months. The forward margin therefore is forward period x interest differential x spot rate. Forward margin equals 100 times number of days in the year. 180 times 8 times 1.5,000 equals 100 times 360. The forward margin for 180 days equals 0.0600. The forward rate is obtained by adding the forward margin to spot rate. Forward rate is equal to spot rate plus or minus forward margin. Forward quotation. The forward quotation for a currency will be quoted with the following information based: the spot rate and the forward margin. Given this, the forward rate has to be calculated by loading the forward margin into the spot rate. Example, on 25th January in the interbank market, the US dollar is quoted as follows. Spot US S1 equals RS 42.4,000 to 2,100. Spot February 2,000 to 2,100. Spot March 3,500 to 3,600. In the above quotation, the first statement is the spot rate for dollar. The first, the buying rate, RS 42.4,000, and the second, RS 42.4,200, the selling rate, while the one given as a spot February and the spot March forward margin for the above months respectively, the margin is expressed in a point that is 0.0001 of the currency. Therefore, the forward margin for February is 20 paise and 21 paise. Under direct quotation, in the first rate in the spot quotation is for buying and second for selling foreign currency. Correspondingly, in the forward margin, the first rates relate to buying and second the selling. Taking spot February as example, the margin of 20 paise is 4 for case and 20 paise for sale for foreign currency, where the forward margin for a month is given in ascending order. It indicates that the forward currency is at premium. The outright forward rates arrive at by adding the forward margin to the spot rate. Example, buying rate, selling rate, February, March, spot rate 42.4,000, 42.4,000, 42.4,000, 42.4,200, 42.4,200. Add premium 0.2,000, 0.3,500, 0.2,100, 0.3,600. Forward rates 42.6,000, 42.7,500, 42.6,300, 42.7,800. Now we got from the above calculation the outright rates buying, selling, spot delivery. USD1 equals RS 42.4,000, 42.4,200. Forward delivery February 42.6,000 to 42.6,300. Forward delivery March 42.7,500, 42.7,800. On the other hand, if forward currency is at discount, the quotation will be indicated by quoting the forward margin in the descending order. For instance, if the quotation for interbank market for pound sterling on 20th April as follows: spot GBP 1 equals RS 68.4,000 to 4,300, spot May 3,800 to 3,600, spot June 5,700, 5,400. In this example, the forward margin is in descending order 3,800, 3,600. Then the forward sterling rate would be at discount. The forward rates can be calculated as followed. Example, buying rate, selling rate, May, June, spot rate 68.4,000, 68.4,000, 68.4,300, 68.4,300. Less discount 0.3,800, 0.5,700, 0.3,600, 0.5,400. Forward rates 68.0200, 67.8,300, 68.700, 67.8,900. Thus we get the outright of pound sterling as followed: buying, selling, spot delivery GDP 1 RS 68.4,000, 68.4,300. Forward delivery May 68.2,000, 68.700. Forward delivery June 67.8,300, 67.8,900.